Okay, thank you. It's now 1 o'clock, and firstly, good afternoon, everyone. This is our weekly podcast, and I'm Mark Young, and I've got Sam Leiksman from Propeller Industries, who will be our keynote speaker today. I'm very excited to hear what he has to say about, I'll just say, tax, accounting, and regulatory pertaining to crypto, which is frankly something that's still evolving, a lot of uncertainty, and we have someone who's on the front lines. Plus, he sees what's happening in the market, which also I think will be really exciting for people to listen to what the mood is by the VCs and the service providers, because it's been a topsy-turvy year for crypto, as we all know. But let's get started. So firstly, good afternoon, everyone. Jerry, go to the next slide, please. Well, we can't have a presentation without a disclaimer. And for those that have been on previous podcasts, this will sound very familiar. But basically, we're encouraged, we're allowed to give financial education. We're discouraged and not allowed to give investment advice. So if you're gleaning something that you think is investment advice, obviously, we want you to share that with your investment professionals and make informed decisions that way. Okay, go to the next slide, Jerry. Jerry, I'm going to ask you on my screen, this is not a full screen picture of the PowerPoint. Can you make it bigger? I don't know, Jerry, if you can't make it bigger, that's okay. So net, as people recall, private wealth management is an important aspect of what Bridgepoint does. And we think of private wealth as a four-legged stool, which is this clever graphic on the left-hand side, but your net worth, which is the combination of your liquid and non-investable assets, it's trust and estate planning, it's tax planning and insurance. And just so we're crystal clear, in America, anybody can sue anybody at any time for any reason. So if you have wealth, I encourage people to have financial moats around their net worth so that they don't get the frivolous lawsuits and lose hard-earned capital that they made. All right, go to the next slide, Joe. So again, a little tough to read, but the fact is asset allocation, many studies, this is just one of many, is the name of the game. It's not market timing. It's not the hot security, I call it the Kramer deal of the day. But the fact is, getting your asset allocation right is the key. If you look on the far right, you see three separate portfolios, all equity, all fixed income, and then what we believe is the optimal portfolio. And you want to be in the top left quartile, which has the highest return with the least risk. So this approach is something that I deployed for the partners at McKinsey, and it's based on, I'll just say, 25 years of their R&D investment prowess. And if people would like to learn more about this, we'd be happy to schedule time for people to walk them through this financial education piece. Okay, now we get to the star of the show. So Sam, would you be kind enough to introduce yourself to the audience?
Sure. Well, good to meet everyone. My name is Sam Leichman. I lead the crypto Web3 practice at Propeller Industries. Got a few slides that'll go a little bit more into what Propeller is and sort of my background, but we basically are a full stack outsourced CFO solution for VC-backed startups. I'm working with about 40 terrific projects, including Optimism, Solana, Masari, a bunch of others. But we'll get into a little bit more about me and Propeller in the presentation.
Okay, next slide, Jerry.
Okay, great. So I'm gonna just hop in. I think that there is. We've talked a little bit about accounting and tax that as it pertains to crypto. Treasury is also a major focus for crypto native and blockchain related startups. I'm going to touch on probably all three of those things in different ways. Any one could require a multi-day conference or get-together. So this is really going to be kind of give a little bit of a perspective of how we look at how we work with our crypto clients. Going to go a little bit deep in some areas, and to Mark's point, and I guess the DNA of these talks, really want to make this conversational. So I will, please, I'm not sure the best way to get questions in, but I'll look to Mark to open the floor as needed. But you can go to the next slide. A little bit about Propeller. We were started about 14 years ago, really to serve as a full stack outsourced solution for CFO and accounting services to VC-backed startups. The real thought was you've got a founding team that may have raised a couple $1 million seed round. Now seed rounds are turning into $15 million funding events. That's another conversation. But you've got that founding team. They really should be focused on building the product, figuring out how to sell the product and scaling the product, not having a perfect instance of QuickBooks or spending a ton of time doing financial modeling. So what Propeller offers is really, we are time and materials billing, but we offer you exactly the amount of time of every professional along with CFO, finance, and accounting stack as you would need. And that is, CFO that is really strategic advisory and oversight over the engagement, down to finance directors who oversee FP&A, a controller who is exactly as it sounds, a controller for our engagements, and then bookkeepers or staff accountants who are basically work out of our international offices. We've got one in the Philippines and one in India. Propeller has, as I mentioned, we've been around for 14 years. We are currently working with about 400 active engagements. We've graduated another 300 engagements. We got our start in really focusing in on SaaS and CPG. And that was probably the first 11 years of Propeller, 10 years of Propeller. And then crypto came through the door. But we can go to the next. Well, any questions on Propeller, what we do at the highest level? Or
Sam, not a question, but I'll just say a comment. With the VCs, they have to back disruptors, innovators, but they also have to make sure there's a financial steward that's watching the money.
Oh, sorry.
No, please go ahead.
Yeah, no, Mark, that's. I mean, you're exactly on point to where we probably get most of our business. Basically, in many cases, I was saying, you've got that seed round or even a Series A. In some cases, a VC will say you need to engage Propeller. In other cases, it's you should probably take a look at Propeller. And in other cases, we've had clients that have come to us who have gone to raise their Series A, and a VC would look at their books and say, we're not going to touch you guys until you get your house in order. And we would start an engagement at that point. So I would say that I would say most of our, from a crypto lens, clients have come from Andreessen, DCG, and sort of by way of those investments also from Deloitte. So it is, we're not putting up our flag at conferences. It's very much we are here to be sort of the adults in the room at times, and make sure that there's financial stewardship.
Okay, great. By the way, if anyone in the audience has raised VC money and a VC suggests you should work with Propeller, which clearly they do, it's not a mandate, but it might as well be. They gave you the money and you want to keep them happy. So you're in a very unique and powerful position, Sam. Sorry, my cough.
No problem.
Excuse me. Okay, next slide, Trey.
So I had worked in our SaaS practice as a SaaS CFO for a little bit of Propeller. My background originally was investment banking. Jumped over, did one round of startup fun, and then jumped back into corporate FP&A for a public company, design within reach. Then decided that I was not enough of a glutton for punishment, so I went back in and did another startup. And then my wife informed me that I needed a job with healthcare and a regular paycheck. So joined Propeller. Really loved working with early stage businesses. And I say for my first little bit there was really focused on SaaS. Was sitting in at one of our weekly resourcing meetings, and our resourcing manager came in and said, "We've got this new client. They're doing Bitcoin, blockchain, crypto. I've got no idea what they do. Who wants it?" And I was a guy who was like, "I'll take that on." And anyway, that client ended up being Solana Labs about 3.5 years ago. So it was, for me, being new to the space. It was like being 16 years old and learning how to drive a Formula One Ferrari, and just knowing, not having any idea what these paddle switches and buttons do, but knowing it is really powerful and really cool. And that really was my kind of step down the rabbit hole. In working with them, it became very clear, number one, just the relevance of what they were doing, the opportunity within the industry, but also, they didn't even have a token then. They hadn't even launched their mainnet at that point. But it was very clear that with tokens being introduced, that in addition to the finance and accounting work that we were doing, there was also going to be a need for crypto finance and crypto accounting. And we'll get into that within the deck. But yeah, so it was, I would call something of a slippery slope down the rabbit hole. We, since in the last 3.5 years, have grown that one engagement to we're over 40 now, but working with some incredible clients, a few I mentioned, but really within a few sub verticals, including infrastructure, foundations, Web3, crypto finance, NFT gaming, and media. But next slide, please. All right, I just give a little bit of a kind of VC-backed startup mini history. In the beginning, or at least pre-crypto, VC cash was really the lifeblood of an organization. A founder or CEO could easily lose their job for getting cute with investment or yield. And the balance sheet existed to tell investors and managers what a business owned, its assets, what it owed, its liabilities, and how much investors have invested. And really, when you look at it through a investor lens, the only goal, again, the crypto model has sort of broken this a little bit, was if you raise a seed, your goal is to get to a Series A. If you're at A, you're to get to B, B to C. And going public is like getting to the NFL if you're, a high school player. It's a super long shot, but hopefully there is a liquidity event, and that's a win. I think, and again, I can probably get into more detail about how the life cycle of a crypto startup goes, and that is still getting funded with equity, but that is your lab. The lab then spins up a protocol which lives potentially in perpetuity on chain, and then tokens get released, and a foundation, generally offshore, is created. So in a few ways, just this model has changed a lot for what a VC, or for what a traditional, let's say, SaaS business would look like. But there's a couple other things that have sort of, I think, with the rise of crypto, that has kind of just turned a few things on its head. The balance sheet for a crypto startup is fundamentally broken. You are required per GAAP to track your digital assets at the lower of cost or impaired value, which really means you've got no visibility to actually what you own if you're to look at the the balance sheet. And you also will have really no sense of what your fair market value is. We'll get a little bit into that in a moment. And this is beginning to really broach into what people are commonly referring to as crypto treasury. And you get 5 crypto professionals, finance professionals in a room, and ask them what crypto treasury is you'll get 9 different answers. And that's again, there's plenty of things here we can double click on and spend the day talking about. But that is kind of the state we're in. On the next slide we'll get into, I'm going to get into a little bit of how do we actually account for digital assets, and this will all kind of circle back in the end. But Mark, any thoughts?
Yeah, I just say re-emphasize the comment you made that the financial statements for these crypto companies accounting for digital assets at the lower of cost or impaired value, that's useless. They're not. How can an investor derive any value based on that? They're not using these financials and investing based on these financials at lower cost or impaired value. So clearly something needs to happen soon to address this. And I'll just say an observation from my time in the accounting profession, which is where I started my career at PwC in Boston. When the profession doesn't know what to do with the major financials, they have the footnotes. So a lot of times they defer and just put all the information in the footnote and let the investors or users of the financials try to figure it out. But at a bare minimum, you need to give people what they need to make informed decisions. And right now, they're not getting that.
Absolutely. And I think let's go to the next slide. And I think this will kind of give you a little bit of how do we do what we do. And then we'll get into, I think, some of the issues that, specific to what Mark just mentioned. And then, again, a little bit of a foreshadow. We'll jump into how do we address this? How do we give our clients the visibility to, again, make informed, actionable decisions based on what's in their wallet? So getting into this, we have on the left-hand side kind of our QBO or GL that should look pretty familiar. Got the income statement on the left, the balance sheet in the middle. All of our fiat accounting would be flowing through here, payroll, any kind of expenses, expense reimbursement, marketing expenses, and so forth. But then when you start talking about having a business that has revenue, cost of sales, other expenses that are in crypto in a non-stable coin denomination, you face a bunch of questions, and it's how do you price things? What is the how do you if you're collecting revenue in ETH, how does that hit your financials? And essentially we rely heavily on a crypto subledger to basically be able to price this stuff correctly, give us the journal entries for the P&L. Interesting point, when you actually a single transaction could actually have multiple taxable events as a result of using crypto. But so if your revenue is coming in, obviously that's ordinary income. But if you're spending, let's say ETH on cost of sales, or you're pushing out your native token on for some kind of payroll or compensation, both of those can be triggering cap gains. And all of that, obviously, you have to have going back to what we're talking about, the balance sheet, your crypto is tracked at the lower of cost or impaired value. So when you actually send crypto out as operating expenses or cost of sales, and there's a gain on that, that is going to trigger a realized gain. Could also trigger a realized loss as well. But all of that needs to be tracked, and that is in the crypto subledger. And again, as we were talking about, on the balance sheet, your entire digital asset treasury is a single entry. And I'll get into exactly how we're dealing with that in the coming slides. But basically, as I said before, the financials are, you have journal entries that are informing revenue, cost of sales, and expenses. You're all of a sudden may have magically additional realized losses that'll hit your income statement. And then your balance sheet is going to show a number that is going to be the lower of cost or impaired value. But Mark, I think this kind of double clicks a little bit on what you said in terms of, great, we can take on-chain activity, turn it into GAAP financials, but it really gives us, there's really kind of unless you have supporting schedules, it doesn't give you the full picture.
It's a quagmire, no question.
And I think if you go to the next slide, you can, I think this is exactly what does it not tell you. As we were just looking at with the income statement, it does not give you an inventory of your digital assets. It doesn't tell you what your tax liability that's lurking around your digital assets are. Kind of a funny situation. You hear about firms having massive, treasuries of native tokens. If a crypto firm has minted but has not circulated their native tokens, those tokens are sitting on the balance sheet at a zero cost basis. So you've got no idea what the real value is of those. And then obviously, if you wanted to just liquidate them, you've got no really insight into it's not what the fair market value is. It's the fair market value with a capital gains tax implication as well. And ultimately, again, I think liquidity is really what we try to get to. And I think there's I don't know if I should dive into this, but the role for treasury in a crypto startup is kind of a sliding scale. And there'll be some images that we'll be able to demonstrate this, but this really, there's going to be the question, what's in your wallet and how are you looking at your entire treasury? And I guess, the old school treasurer job was really focused on cash management, liquidity projections, treasury operations, bank relationships, cash accounting, really not very exciting stuff. And it's, what treasury means for a crypto native business is a lot more around operations. It's a lot more around actually, running the business. And anyway, so that, again, a little bit of a preview of things that we'll be seeing in a moment or two.
Hey, Sam, I got a really dumb question.
Yep.
But you mentioned the crypto coins and they're on the balance sheet. Firstly, if you have the coins, you could potentially create an infinite supply of these coins. Now, granted, I think at some stage you disclose how many coins you're going to actually have authorized to issue, right?
Yeah, well, so let's go back to sort of the life cycle of a crypto project. You'll have a lab that's going to be funded by venture capital dollars. There's going to be an equity stack, and then there's going to be a very public spin up of what the protocol is. Supporting that protocol is going to be the token issuance plan, which is, it's kind of a one and done thing. And it's going to be in that token issuance plan. They will typically give a bunch to investors, to the VCs. And actually going back to the VC conversation we were having before, we've seen 9-figure deals of cash going into labs that are, obviously they're on the cap table for an equity ownership. But the realization of the investment is going to be seen in the tokens that those VCs are receiving in return. And so to answer your question, I don't mean to be curt, but no, once a credible project and a credible protocol will not have a second issuance of tokens. It is, here's 100% of the tokens that are being issued. Typically, again, it'll be maybe 20% going to the VCs, maybe 20% going to management, 20% going to the community, and then a whole bunch more left in treasury to basically serve as a way to encourage people to get on the protocol as it gets some traction and usage. But it really is and it's very much put out there in a very, whether it's through Discord or through other very open ways. But yeah, there's not a credible project that would have a surprise, oh, by the way, we're just going to mint more tokens.
Okay. I'm imagining the balance sheet, and these tokens, are they in the equity portion of the balance sheet? Are they in the debt portion? Where does this position reside?
It'll actually sit in assets. So your tokens will be, let's say a business is, I've got a layer 2 client that makes its revenue in ETH. It has cost of sales in ETH, and it just released its own native token. All of that is sitting within its crypto subledger, and it is ultimately all reported on the balance sheet in a single line item. Now, I'm going to simplify this a little bit, but the fair market value, because maybe some tokens may have been released already, could be $5 billion for the market cap of XYZ token, and 20% of that might be sitting within the lab or the organization that spun that token up. But that token, if they were the ones that minted those tokens and they have not distributed those tokens, even if it's $1 billion, sits on the balance sheet at a zero cost basis. So again, I think if we go to the next slide, I think this is, there is a question I think that Mark's bringing up of, how do you make sense of this to look at a investment opportunity? I think that where, I'm going to be going is, this is what we have put together to help our clients, make sense of their own treasury. So if you could go to the next slide. All right, statement of digital assets. My turn to do a few disclaimers here. But the way we look at what I'm about to show you is, it's really a fourth financial statement. This is the schedule, the footnote that Mark was referring to before. Basically, this is important for us to be able to show that we can make sense of that single line item of digital assets. But then also, how can we then, be able to not just say, okay, well, if there's $10 million of sitting digital assets, what else can we do with that number once we can, show the build? And then basically what I'm about to share with you, these are use cases of things we've seen before, not within a single client. If you work in crypto, what the wallet infrastructure I'm going to share with you will make no sense, but it's really for demonstrative purposes only, and it'll there to tell a story. So, we can go to the next slide. Okay, so again, and I'll talk through this, and then I'll look to you, Mark, to again, getting back to your footnote comment. This is essentially the work paper that will, it's kind of the first order question of what's in your wallet. So you can see at the bottom, we have $11.763 million of book or impaired value. And that would be what would be represented on the balance sheet. And so the first thing we do is say, okay, well, what is the build to get to that number? And we basically break that out by digital asset type and by wallet. And so, it's easy to then say, okay, well, you've got a hot wallet, you've got a wallet for R&D, you've got, maybe some wallets that have been spun up for tax strategies. Maybe you're sitting on a Bored Ape Yacht Club NFT. There could be some DeFi stuff that you're doing, but let's get the full picture of not just what the amount is that we're putting on the balance sheet, but what's the makeup of that amount. The next thing we do, again, this is sort of the first kind of step down the road, is what is our just our digital assets. What does that look like if we were to mark them to market and say, in today's value, that 11.7, well, you take a look and, the price of ETH has gone up in this scenario. But you also see that you've got your native token there, native token uncirculated XYZ, 10 million. Guess what? That's not sitting on your balance sheet at a single dollar. That's at a zero balance. But the reality is, if you've got another 10 million of your own tokens that are circulating, and you're sitting on another 10 million, there is a notional value there. Now, if you try to dump them all, you'll have tax consequences and it'll dilute the market. But at least this is beginning to give you an idea of your liquidity, and we are going to go deeper. But yeah, Mark, any takes on it? And this is kind of the what the footnotes would be beginning to make reference to.
Well, I want to just lob a couple questions at you, Sam, that came from the audience, if that's okay. First question is from Charles Schwarr. Are there any tax loopholes? And that's not a great word for people in our profession, but are there any tax strategies, perhaps, with crypto, since it's considered a cost?
Yes, and so one way to let me preface this by saying that the tax regime is changing. We are going to be in for some announcements in the next 6, 12, 18, 36 months. I'm not sure. IRS, it's not on the immediate docket for announcements for the IRS, but there will be adjustments made. As I mentioned, digital assets and crypto is considered a intangible asset, and it's treated as such, and it hasn't been really nuanced out of that. The IRS has made comments about this, and anyway, to answer your question, so one method that we use is, if you're a crypto business and you're getting revenue in crypto, and you can see I've actually made an example of this revenue collection October through January. You can begin to bucket your revenue and put them into specific wallets. Really, and this is primarily for tax loss harvesting and gain. So what your basis is in ETH in each of those wallets, and depending on where ETH is trading, when you want to use those for cost of sales or for expenses, or if you just want to sell them, you've got a little bit of control over what your tax liability will be at the time. In terms of other tax strategies, getting a good crypto accountant is probably the best one that I could think of. And on a personal level, there are a few folks that I could think of, and then on the corporate level, we work closely with Deloitte, as well as a bunch of regional firms and even smaller boutique firms. Happy to give referrals to any and all after the call.
All right. Well, thank you. Just one more question, Sam.
Yep.
What are some types of cryptocurrency tax events? How is DeFi taxed?
Wow. Okay. This is a very vague, and this is not a short answer, and the rules are not very clear. I would always defer back to kind of the tax rule where you incur tax liability when revenue is earned for goods and services. There was a recent there might be, I'm sure many of you have heard about proof of stake and this move that Ethereum made from proof of work to proof of stake, and the ability for individuals now to essentially put their Ethereum into a staking service and get yield back because they're helping to secure the network. There was recently an IRS case called Jarek, which I'm going to preface this by saying resolved nothing and made it completely ambiguous. But there was a question about whether, because you were actually creating new Ethereum, does this, are you earning ETH rewards, or are you creating them? If you're creating them, think about if you're a chair maker, you build a chair, you're not taxed when you finish your chair, you're taxed when you sell your chair. But if you're earning them, it's a different story from a tax perspective. That was the IRS reviewed it, and they chose not to make a definitive ruling on it. That's something that will be sorted out. I think the other piece that really, and I was going to actually bring this up as an example, but most important is, like I said, it's your tax liability is incurred when your revenue is earned. I spoke with a PFP project, an NFT project. You might be familiar with Bored Apes and other similar NFTs projects. But basically, there are it's generative art, 10,000 of these things of different themes. Anyway, this group sold out in Q4 of last year. $8 million of revenue. The way the transactions work is people send in Ethereum, and then they exchange that for their NFT. That's great. $8 million in revenue a year ago. Had a conversation with them back in June of this year. They were just beginning to get their books in order. It's typically when we get involved. And the question came up of like, well, great, we had this, sale, $8 million of revenue last year. How should we be planning for this? What are the taxes? And, the question was like, well, your taxes are based on the $8 million of revenue you made. They're like, well, we haven't sold any of our Ethereum. Between last year and June, Ethereum went from almost $4,000 per ETH to $1,500 per ETH. And they are still sitting on the same asset that was traded for them, and they can't afford to pay the taxes that they owe. So that's a big cautionary tale. And so, the government wants to get its due. They will get their due, and it will be in dollars based on the dollar amount when the transaction took place.
Well, again, it sounds like a minefield, but I'll just say it's the Full Employment Act for Propeller Industries and Sam Leichman. How's that?
I love it. No, this is there are, I think, two kinds of accountants and finance people in the world: people who got into this stuff to color between the lines and do their bank recs every Friday and payroll every other Tuesday, and then folks who kind of thrive a little bit on ambiguity and kind of getting into new stuff. So anyway, getting into our next slide. Again, this is really focusing in, again, once you begin to say, all right, well, at least we know how we can reconcile to our balance sheet. Let's actually think about, what does it all mean? And so, in addition to, at the very bottom of the screen, you can see we pull in our cash and cash equivalents. In this case, it's USDC, which is a stable coin. Technically, there's some discussion of whether stablecoin should belong in that digital asset line or in cash. I like to think of that as, especially USDC, not some algorithmic derivative, but like if you've got a circle-backed stablecoin, you want to consider it as cash. It's cash. It operates as cash. When we think about our clients and what their cash out timeline looks like, that really needs to be, what is your cash? And if you spent all of your cash, how many months left do you have to operate? And in my opinion, that should include stablecoins. So anyway, that's why we've broken that out. And so, the goal here is first to say, not just what is your, full picture, but it is, what is, the full picture, including cash. And then let's begin to actually, address, not just what are each of the wallets, but what are they there for? And so, some common buckets include ops and admin, tax strategies, DeFi yield, again, the native uncirculated tokens, that may be sitting at a zero basis, tax and other liability wallets. And of course, as I mentioned, making sure that your fiat balances are included. And let's, yeah.
Okay.
And Mark, any questions on that?
Honestly, too many, so I don't want to hog or take us down a rat hole. But let's go to the next slide if that's okay.
Great. So great. This is making sense of it all. There are actually two other points too that we want to make sure that we capture, and those are kind of off-balance sheet transactions. There can be loans that a project will make of their native tokens to the ecosystem, and there are also I'm guessing that there are probably a fair number of finance professionals on this call. There's a role of a market maker for crypto assets, which look a lot different from what a market maker for NASDAQ, or I should actually say my first job in finance was actually on the floor of the New York Stock Exchange for a specialist broker. But what a market maker does for a crypto asset doesn't look exactly like what it is in traditional finance and capital markets. Again, another longer story, but these things can exist off balance sheet and have to be taken into account. So, but ultimately, getting back to this slide, what we want to be doing for our clients is making sense of it all. And it's saying, at the end of the day, here's your, let's get it to fair market value. Let's take a look at, how does this all break out by the roles of your wallets? And ultimately, this really kind of tells you how you should be thinking about running your business, and also where's your exposure. Do you need to be taking some of your native uncirculated off the table, putting them into a stablecoin yield? Are you overexposed to some kind of yield strategy? And this is the kind of thing that we present to our clients on a monthly basis. So we would go through a close, we would go through a variance analysis on the P&L, but then really spend probably most of our time really talking about, what is the state of the treasury. And treasury, again, from a crypto perspective, is everything from, traditional asset allocation to, how are we thinking about making sure that we've got money to spend on expenses, to do we want to go and institute a yield strategy. And again, this is, kind of just scratching the tip of this of just touching the top of the surface, but it really is, again, our goal is to present a full picture to our clients.
Okay, Joe, you want to go to the next slide?
Now, so talking a little bit about tax, addressing the question that came up before. So a couple of things. Number one, if you're sitting on like the native token scenario that I mentioned before, just because you take your quantity of native tokens and multiply it by the current value, that gives you a nice big number, but it also doesn't tell you what your tax liability is. That's something that, again, we need to be, making really, really clear to our clients, that just because the fair market value of, comes to a $27 million number, there is a tax liability associated with it. So as we dig into that kind of full dashboard view, there is a double click that has to be acknowledged about kind of what's sitting in taxes. And then getting back to that earlier question, again, this, from a tax loss harvesting strategy, being able to drop your revenue from a specific month into a specific wallet will allow you to pick and choose which ETH or whichever native currency you want to deploy based on where the pricing is. There is another, we'll call it a great white whale tax opportunity with crypto that I've yet to see deployed ever, but it's called specific lot tracking. And that is basically saying for every crypto transaction, you can identify exactly what the basis was for that particular currency. Yes, if you're talking about a personal portfolio with half a dozen transactions, a month, and you can really look at and understand everything you've got. great, maybe that works. We've got clients with millions of transactions in ETH coming in a month. Theoretically, the system should be able to, pick and choose, but that really doesn't. I've yet to see that happen. For the most part, we deploy LIFO across a portfolio, or LIFO by wallet, which again allows us to do some of the tax harvesting that I'm pointing out to in the second example on this page.
So is it fair to say, Sam, that the market convention is LIFO for?
At this point, it is. I've seen FIFO deployed. This is stuff that I suspect will be addressed in the coming, hopefully, reporting regime. That again, I'm not sure when that will be apparent, but that should be coming out in the next 36 months.
Well, let me just say at a very high level, the challenges that crypto is placing on the profession that you're involved with also applies to the regulators. And the fact is, crypto is more advanced than the regulators who are trying to play catch up. So,
the regulators who are trying to play catch up, and excuse my language, the regulators who are not trying very hard to play catch up in some instances. I have a very good friend who was at the SEC, and prior to Gary Gensler, part of his role was to basically take informal coffee talks with founding teams. Part of that was, very much, like, we want to do X, Y, and Z. And the response would be, well, here are things you should think about. With the current SEC administration, those meetings have gotten shelved. That doesn't happen anymore. And I think there's, again, regulatory stuff is another big discussion that is, we're getting to 13 minutes left on our call. But yeah, it's coming, and it's not clear for sure.
Well, you're right on both those data points, but I'll just make a bet. I'll say a side bet with you that the SEC is going to want to call it a security and regulate it, but time will tell.
Well, you're seeing now actually a pretty, it's sort of fun to watch the turf battle between the SEC and the CFTC kind of duke it out. The other thing that I think was a really interesting thing that happened back with the infrastructure bill, there was a little bit of Washington politicking, and a pay for provision a crypto tax was included as a part of a pay for provision, saying that miners, there was $30 billion of uncollected taxes left on the table, which was not a correct assessment, but it got put in there as a part of the budget. And very quickly, there was you saw, and I don't think anyone was expecting this, the crypto industry got just all of a sudden mobilized from a political lens, and just a ton of money got behind the Blockchain Association, Chamber of Digital Commerce, and while they were not able to fully block that provision from getting into the infrastructure bill, that's a fight that's still going on. And there's just a ton of money now getting in on the crypto side. As you can guess, there's a lot of money that's been made, but the coordination of that has been really, really impressive as well.
Well said. I agree. I know we're getting near the end of our time. Maybe we just go to the next slide, please. The key takeaways. Woo!
Yeah, look, and again, this is, this was probably meant more from a treasury presentation perspective, but I think this is a very valid still. But the whole point is to get a full picture of liquidity. There are a lot of ways to get there, but as we were talking about earlier, you need to be able to double click on your digital assets, what you're reporting on the balance sheet, to really understand what's in there. And again, I think I put this slide together back in May when, Celsius was still around and you were hearing about, 400% APR, APY, 20%, just yields that were silly, and people really thought that their treasury was really focused on, making money. And again, part of my job is being very risk averse for my clients, and going back to the NFT example I gave you before, just make sure you got enough money to pay your taxes. So anyway, that's what I have, and happy to take questions for the next 10 minutes. Also happy to be available to field any questions or meet with folks. I'm on LinkedIn. My email address was on the front of the deck, but I'm sure you can get that from Mark afterwards as well.
Well, firstly, Sam, I just want to thank you again for sharing, I'll just say, these keen insights, literally from, I'll just say, the battleground, because you're fighting the fight every day. And it's just fascinating. This huge industry is still trying to sort out basic fundamentals, like how you account for this stuff. But it will get figured out, and how soon, time will tell. But, I'll just say, challenge is also an opportunity. There's clearly misalignment of information for users of these financial statements. So we'll have to see how the market exploits this, I'll just say, information gap. But Sam, as always, you were great. Thank you, my friend. I really appreciate it. And we will have our session next Thursday. I just got confirmation that we will have the CEO of New Lab, who's spoken once before, but Sean Stewart's his name, and what they're doing is breathtaking, and I'm excited to share their updates with you next week as well. So everybody, thank you so much for your time, and have a great day.
Thank you for having me, Mark.
Thank you.